Hi, this is Michael O'Leary from By the Book Taxes, back with another video blog. Over the next several weeks, I am going to do video blogs, several of them, on payroll taxes and the tax resolution aspects associated with payroll tax liabilities. Most people think of income taxes when they think of tax resolution and when they have tax debts, but you also see the business side of this with payroll tax liabilities. And in this video blog, I'm going to give you an overview of that before we go into greater detail in future weeks. Okay, so if you're a W-2 employee, you have taxes withheld from your earnings every paycheck. You have Social Security and Medicare taxes withheld. You have federal income tax withheld, and you have state income tax withheld unless you live in a state without a state income tax. These withholdings are considered trust taxes because the state and the federal government trust that the business owners will collect this withholding, file their payroll tax returns, and send the tax withholdings along to the appropriate taxing authority, either the feds or the state. About 70% of the federal government, the United States Treasury's tax receipts, are from withholdings of either federal income tax or what's known as FICA taxes, which are the Social Security and Medicare taxes. Also, about 75% of the collection cases initiated by Internal Revenue Service revenue officers involve businesses that do not forward these withholdings on to the United States Treasury. Two reasons why business owners don't forward the payroll taxes that they withhold from employees onto the taxing authorities. They're struggling or failing. They have cash flow problems. It's easier to use this money that they're withholding from employees than going to the bank and getting a loan. So they just take the money and use it to fund the day-to-day operations. They keep paying their employees, otherwise the employees would leave. And they keep paying their vendors so they can keep getting product or supplies or whatever. That's the main reason. The second one is the business owners are actually criminals and they're embezzling the money and using it to fund their lavish lifestyle. The IRS is very aggressive in prosecuting these cases because they want to send the message that you cannot do this because the government relies so much on collecting these taxes in order to fund their operations. Because every day, as the population ages, more people are filing for Social Security benefits. And people are continuing to file tax returns expecting their refunds. So the government is taking a double hit in that they're not collecting the taxes, but they are then having to pay out these refunds and benefits. A big tool that the IRS uses to dissuade people from doing this is called the trust fund recovery penalty, where in addition to going after the business to get these taxes paid, they can also come after responsible people within the company, the owners, the chief financial officer, the controller, the payroll person, all of them. They can come after them personally to collect this money, not just the business. Very powerful tool, the trust fund recovery penalty. Here's a case example. Karen and Russell Rucker operated an insurance agency in Huntington, West Virginia, but not anymore. They embezzled a lot of payroll tax money, did not file their payroll tax returns, did not file their personal tax returns, engaged in knowing, willful fraud and embezzlement. And now you can read about them on a recent press release issued by the tax division of the United States Justice Department. Please don't be the Ruckers. If you have a business and you're struggling and you haven't paid your payroll taxes lately, or if you haven't filed your tax returns as an individual or owe the IRS a bunch of money, please call me. I can help.